Good morning students. Now Ayodhya, Jayasuriya and Sabaresh is going to present about the equity shares and debentures and basics of mutual fund. Okay. All of you listen carefully. Then after the session, if you have any doubt, you can ask me.
So very good morning. So I will tell you the meaning of equity shares and debentures. Equity shares is nothing but you are representing a company and you have rights in the company to ask what is the profit in that year or in that month, how much the company has earned or anything like that. So the debt is debenture is nothing but you are liable to pay to someone. You got loan from a bank, that is you are on debt to the bank. You got borrowed money from somewhere, you are in debt. You have to pay. So asset comes under equity shares. Equity shares are called assets and debentures are liabilities. So you have to pay to someone. So you are liable to pay. This is what is the outline of equity shares and debentures. So they will be explaining in detail.
So let's move on with equity share. Equity share is nothing about our ownership of a company, where you buy some stocks and you become a part of the company as saying as a owner. You have all the rights to own in a company while taking decisions in marketing, expenditure, research, and all these stuff. And also you have the dividend. You have the rights to buy the dividend of the company. Dividend is nothing but a kind of profit amount which you give to the shareholders. The main key feature of equity share, you have all rights in the company to say that I am a owner of this company and I have all these rights to gain the profit, and I am also involved in the losses of the company, and I own the big part of the company. And moreover, the voting rights comes only for the equity shareholders has the rights to vote in the company. No matter other than any other holders will not have all these kind of stuff. And therefore, it is like a legal way of owning the company in the physical and as well as in the paper value. Thank you.
Tell about debentures. Debentures is a long-term loan where you get a capital of loan. Like when you're starting a business or you're starting the startup business also, when debentures, like you get a long term of a loan and you have to pay a fixed rate of interest to it. So like basically, if you're starting a business, you need actually a capital amount to start a business. So you can borrow a loan from that, and you have to pay from how much ever you're getting a profit starting. You have to get a fixed rate of interest. So according to how much ever profit you are getting, you have to calculate the amount and you have to pay the rate of interest to it. So debentures will be helping for you to take long term of debt for you.
Sir, issuing the equity shares and debentures. For what purpose means here? For getting the financial sources from the public. Okay. So those who are holding the equity shares, they are called as the owner of the business because they have the rights to vote. Okay. So they are called as owner of the business. Then debentures. The debentures are the creditors of the business. Here the debenture holders are creditors because they are investing the money to the business. Then when the business needs the finance, then they will issue the debentures. Then those who are investing in the debentures, they are called as creditors. Okay, for their investment they are getting the interest, but here the equity shareholders are getting the dividend from their profit. Okay, from business profit they are getting the dividend.
So when it comes to basic of mutual fund is nothing but the investors are ready to invest in a particular company, or they mostly invest on securities, bonds and all. So this is what is called mutual fund. So this is managed by the professional fund manager. So when professional fund manager takes over everything, and he is the one who invests in any of the securities, keeping a security or in any bonds. This is what is called mutual fund. So in mutual fund we have three types. Okay. So the first one is equity, second one is debt, and the third one is hybrid. So the first one, equity mutual fund is nothing but they will collect money from the investors and they will invest in the shares only. Only on shares they will invest. That's only called equity mutual fund. And the second one is debt mutual fund is nothing but they invest on securities and bonds. So keeping something as a security, they invest something. And this is also only when the investors are ready to invest, they do this. And hybrid is nothing but they do on both the basis. That is shares as well as securities and bonds. This is the basic and the introduction of mutual fund you can tell. So mutual fund is overall nothing but you are profit, the revenue, whatever you call, we'll be sharing it among 4 of us. So the ratio is equal to 4 of us. We've invested something. If suppose he's investing 1 lakh, I'm investing 2 lakhs, 3 lakhs and 4 lakhs, we'll be getting our profits according to the ratio. 1:4, 2:4, 3:4, 4:4. So you will get according to that ratio. So this is what is called mutual fund. It is controlled by the professional fund manager.